Hello students and welcome again to Legacy IAS Academy. In this lecture, we will be discussing the announcement that has been made by the RBI, which is in line to address the liquidity condition. So we'll see what the liquidity condition is presently and what are the measures that the RBI has announced. So the news is about the threefold measures that the RBI has announced it will do. The first is about 60,000 crore rupees worth of open market operation purchases. It's talking about purchases. Now open market operation consists of purchasing as well as selling. We'll see what the difference is and what when you sell and when you purchase and what impact does it have. We'll see that in detail. So first thing is 60,000 crore of open market operation purchases and of course the government securities. Then you have a 56-day variable repo rate auction. So we might be knowing already about repo rate, which is fixed, right? Every 3 months the monetary policy committee comes up with a notification about the repo rate, which it may change, it may reduce or increase or keep it same. Since last so many quarters, the repo rate has kept unchanged, and when a repo rate is notified, it remains the same at least for the next 3 months until the next monetary policy committee meeting notifies the new rate or a similar rate. So that is a fixed one. But what is this variable one? We'll understand that as well. At the same time, the last but not the least, $5 billion rupee buy sell swap. So what is this dollar rupee swap and how is it going to help? We will see that also in detail. So what is we going to see now? OMOs plus the VRR plus the swap. What are they and how it is going to help the liquidity situation? But before that, what is the actual concern? The concern is of the liquidity issue. Liquidity means the cash issue. Cash issue of what? INR, Indian rupees. With whom? With the banks. That means the banks are having a shortfall of Indian rupees. Means what? They are having less money to give out as loans. Means what? Because of that, the interest rates would be higher because the demand is more but the supply of rupee is less. So RBI wants to increase the supply so that the demand is met, so that the interest rate may come down. That is going to boost the economy. Very simple. Why? Because when the interest rates will go down, you will be more inclined to take loans. More people will be inclined to take loans. When you take loans to do certain thing, to start a business, to buy product, that will increase the demand in the economy. Increasing the demand in the economy is what? Churning the economy towards boost, towards growth. Now, what are the reasons for the liquidity issue in the banks? First is the lag effect. So, governments at times provide certain liquidity, certain infusion, certain incentive directly, indirectly in the market to the bank. But there is always a lag. Lag means what? You want it now, you get it 6 months later. Now 6 months later, you don't need it and now the money is coming. So, it will rather have a reverse effect. So that there is a lag. Now there is a need of the hour, but there is a huge lag. So there is a problem. Liquidity still exists. Then you have inflation control measures. If too much cash is there, that is going to lead to inflation, right? Too much cash, how it leads to inflation? Let's say 100 people have money to buy this one pen and only one pen is there in the market and 100 people have the money to buy it. Of course, there will be inflation. Why? Because if I am the pen seller and you come to me to ask for the pen, I say no, I won't give it to you at 100 rupees. I want 200. You say no, 200 is too much. I'll say fine, go away. Why? Because 99 other people are present. So when more people have more money, that means when more money is in the market, it leads to increase in the prices. It leads to inflation. And one of the job of the RBI is to control inflation because we have an inflation targeting of 4 plus minus 2%. That means inflation needs to be kept between 2 to 6%. So to keep in check, RBI needs to suck out the money also from the market at times, right? But that may lead to slowdown. That may lead to the liquidity issue. So inflation control measure is one such reason. And of course, there are other reasons as well. For example, higher cash withdrawals. So what happens is higher cash withdrawals or lower deposits. Let's say festive season is coming. So you keep on withdrawing cash from the banks. So there is less amount of money with the bank. At the same time, you would not want to deposit because now you would want to spend. So you would not fix deposit it or keep it in the bank because you are about to spend more and more. So what happens? The bank does not have money. Bank give loan from what money? The one we deposit. If I deposit my money for 5 years fixed deposit, the bank will give you loan with that money for the period less than 5 years. Right. At the same time, there are other avenues for the bank also to get money. RBI is one such avenue. But our deposits are also one of the source of money for the banks to give loans to you. So when either the withdrawals are high or the deposits are low, the bank will be having liquidity issue. Okay? Now, so we have understood that there is liquidity issue. Now that liquidity issue needs to be solved, which the RBI is trying to do with the 3 steps it has mentioned. So let us look at each of those steps one by one. What are they and how do they address this liquidity issue problem? Number 1, open market operations. What is open market operation? Open market operation is nothing but simply buying and selling of the government securities. So it's the government securities which are bought and sold in the open market, but by whom? By the RBI. So let us see how does it work. And to address the cash issue, should the RBI sell or buy, we will see that. So what happens is, government security is nothing but a piece of paper. Okay? It is just a piece of paper. So what will RBI do? What happens with the piece of paper is, either you can sell, either the RBI can sell or the RBI can buy. So when the RBI sells this into the market, so RBI gets money from the market, right? RBI sells, so RBI gets money. Now when RBI gets the money, let's say it is selling to banks. The banks can also buy government security. The banks can invest in government security because RBI is selling to banks. Let's say scheduled commercial banks, and RBI is getting the money. So what is happening? The money is being sucked out from the scheduled commercial bank when RBI is selling the government securities, right? So there will be even less money with the banks to give the loans. Now the second thing the RBI can do is buy this government security from the scheduled commercial banks, which it might have sold previously. It wants to buy it back. It wants to purchase it back. So when RBI purchases back this government security from the banks, RBI will give money to the banks for purchasing it back. So what will happen? More money will be with the banks. More money with the banks means more money to give loans to all of us, to business people, to consumers, to everyone. So what is the government, what is the RBI doing? We saw RBI is going to purchase the government securities through open market operation worth 60,000 crore rupees. That means 60,000 crore rupees are going to be infused in the market through the open market operation. I hope this step is clear and how it is going to impact is clear. Let's move on to the variable repo rate auction. What is repo rate? Repo rate is the rate at which the RBI loans money to the scheduled commercial bank. Now that rate is fixed. Here we are, so that is already there, that facility is already there with the banks to get the loan from the RBI. But this variable rate can be slightly lower also, and that comes in the form of auction. So whichever bank wants however much of money at different interest rates, they can have an auction. There would be an upper ceiling, and below that there would be auctioning, and you as in the banks can buy this or loan this money at variable rates, not a fixed rate. So depending upon requirement of each bank and what they can afford, they can buy it. Variability is very important here, because when the rate is fixed, let's say it's fixed at 6%. Now some of the banks are okay with 6%, some of them are not. Right? Some of them could have even got it at 6.5%. So when it is variable, different banks depending upon different requirements at different percentage can get it. So this is variable repo rate. It is nothing but the same repo rate operation. It is just that the percentage over here varies. So what is the mechanism? Here also the banks are borrowing funds, of course at an interest rate which is repo rate, but it is determined through the auction process, and hence it will be variable. ठीक है. The auction amount of course is decided by the RBI. Amount means how much money you will be getting, I will decide it. You may want 1000 crore, I may be ready to give only 500 crore. ठीक है. That money I will decide. You cannot ask as much as you want as a bank. ठीक है. So it is also a tool under liquidity adjustment facility, means it's a tool which can help manage the liquidity of the banks. Of course, when the banks can borrow at different rates, they will have more money, so they will have liquidity. It is going to increase the liquidity. ठीक है. So variable repo rate is also clear. It is short term tool employed by the RBI to maintain the liquidity of the banks. ठीक है. Now the final one which again the RBI is doing is nothing but USD Indian rupee buy and sell swap. So what the government is sorry, not the government, basically RBI, what the RBI is doing, RBI is going to do the currency swap. So let us understand the concept of currency swap. Now RBI $5 billion worth of $5 billion the RBI is going to buy from the banks. So what is going to happen is RBI is going to buy, RBI is going to understand this, RBI is going to buy $5 billion. When RBI buys $5 billion for the banks, in return RBI will give what? Indian rupees to the bank. So around 43,000 crore rupees will be given to the bank, Indian rupees. Right? That means what? The banks of India will have Indian rupees. They are having liquidity issue with respect to Indian rupees. So by buying $5 billion, RBI is going to infuse 43,000 crore rupees with the banks. Now, after this is a swap deal. In swap deal, buy and sell swap deal, how does it work? I promise to buy dollars from you today at X rate, and I promise to give you those dollars back, let's say after a month, at Y rate. Now this X and Y can be equal, X can be greater, X can be smaller, it depends upon the market situation, but it is going to be pre-decided. So why am I going to buy dollars now? Because right now you need Indian rupees. So I'm going to buy dollars and give you the Indian rupees so that you can do your business, and after doing your business you can earn more and more Indian rupees with the help of the rupees that I have given, and after some period of time I'm going to give you your dollars back and you can give me the Indian rupees back. So you require rupees now, that is why I am doing this entire process. That is why US dollar Indian rupees buy sell swap is being done by RBI, amounting to $5 billion, which is equivalent of around 43,000 crore. So these are the steps that the RBI is doing to address the liquidity issue. Now the budget is just around the corner, so stay tuned with Legacy IAS Academy. We are going to dissect it in detail. So stay tuned. Thank you.